Lecture 1, The Numbers Must Add Up. In CFA Exams Level 1 for 2020 and 2021, the Financial Reporting and Analysis, or FRA for short, consists of 12 readings from reading 19 to 30. We in Rapid Quizzer have a view that if you read the CFA curriculum readings carefully and diligently, the FRA section is just of average difficulty across our 1,800 FRA practice questions, or a difficulty rating of 2.8 in a scale of 5. This lecture gives an overview of financial statements, the first of which is the balance sheet. The balance sheet has a structure that reflects the accounting equation assets equal liabilities plus capital, which is labeled assets equal debt plus equity on this diagram because in other non-FRA readings they're referred to as such. For example, in cost of capital or debt and equity valuation readings, where they're also referred to the relative proportions of debt and equity as a firm's capital structure. On this diagram, the components of the financial statements are marked with their corresponding reading numbers. For example, reading 25 for inventories or reading 28 for bonds payable. The balance sheet reading itself is reading 22, but some components have extended discussion in other readings. For example, property, plant, and equipment in reading 26. Anyway, the accounting equation reflects how assets are funded by debt capital from creditors and equity capital from owners. The accounting equation can also be assets minus debt equals equity. This equation structure emphasizes that creditors have priority claim to assets, and the owners are left with the residue or remainder. That is why equity is called a residual interest. The assets and liabilities are divided between current and non-current, where the current classification is a time period of up to 12 months, unless the operating cycle is longer, such as in producing movies. For example, the company may grant a 60-day credit sales, so its accounts receivable from customers are current assets. Or the company in turn may obtain a 90-day credit from its suppliers, so its accounts payable to them are current liabilities. Production equipment, patents, and the like, with economic benefits beyond 1 year, are non-current assets. Bank loans and bonds are paid over many years, so they are non-current liabilities. No such current non-current classification is applied to equity, but they are divided between original capital and accumulated profits. After creditors, the preferred equity has a priority to assets and profits. Large companies usually own and/or control other companies called subsidiaries, or their child companies operating in different lines of business or geographic locations. The equity not held by the parent in these subsidiaries is a minority interest. The order of presentation of the different assets and liabilities within each grouping incidentally is also according to liquidity, that is, the speed of their conversion to cash. For example, receivables is one step closer to cash than inventories, so receivables is said to be more liquid than inventories. If the company has more current assets than current liabilities, then it is said to be liquid, as it has enough assets realizable within the year to pay for liabilities falling due during the year. Such extra or excess amount is called net working capital. When such net current assets are added to the non-current assets, and their sum exceeds non-current liabilities, the company is said to be solvent because it has enough assets to pay its remaining obligations falling due in the years to come. These measures of liquidity and solvency guide credit decisions and credit ratings for granting debt capital to the firm and the cost of such debt capital. The diagram only shows the balance sheet structure. If we display the amounts, we would get a sense of the company's capital funding, liquidity, and solvency. More accurately, if we transform each amount as a percentage of total assets, then we would see their relative common size. The capital structure, liquidity, solvency, and common size analysis reveal a good picture of the company's financial position. That is why the balance sheet is called the Statement of Financial Position. Is the company's financial position of today's value The balance sheet is reported as of a specific date, so the financial position is as of that date. Assets are recorded generally at cost of acquisition, called historical cost, such as inventories, but can be revalued to market value, such as factory buildings. These bases of measurement are adjusted over time to reflect their economic use or impairment. Does the company's financial position reflect the value of the company? Yes and no. Yes, because the balance sheet reports the book value, which is the accounting terminology for values taken from the accounting records. No, because the value of the company is based on its profit and/or cash generating capability, which we will discuss in valuation readings.